Today, we're digging into a very urgent and bullish investment report on RZLV AI. That's RZLV. The whole case really hangs on this huge projection, $17 million in revenue for just December 2025.
Right, and that single month is meant to signal this big flip over to profitability.
Exactly. So let's get into how we can sharpen this pitch and turn it into something more like an authoritative analysis.
Okay, so first things first. The title of the piece, or at least the framing, is something like $17 million in 1 month, mind blown, why RZLV is about to fly.
Yeah, with the mind-blown emoji and all.
And that right there kind of perfectly captures the main tension. You've got this fundamental clash between the urgent, exciting tone and serious analytical rigor.
It's a tricky balance. I mean, to be fair, the data here is undeniably potent.
Oh, absolutely.
You see a projection for $17 million in 1 month. That leads to a $200 million annual recurring revenue run rate. And then the big one, the flip to EBITDA positive. The report calls it a massive de-risking event, which is correct.
That foundation is solid, completely solid. But, and this is our first major point, the analysis must calibrate its tone to enhance its perceived analytical objectivity.
So you're saying the excitement, the very thing that grabs your attention, is actually working against it?
In this context, yes. The weakness is pretty clear. The report leans really heavily on hyperbolic language. We're talking financial bombshell, massive breakout, tons of capitalization, the emojis.
All the classic hype signals.
Exactly. And while that might generate some buzz, for a sophisticated investor, it just creates this trust deficit. It feels like maybe the writer is overcompensating for something. It reads more like high-energy marketing than sober financial analysis.
Okay, I see that. But let me just push back for a second. If you're trying to get on the radar of retail investors, don't you need some of that energy to cut through the noise? If we sanitize it too much, do we risk losing the momentum the piece is trying to build?
That's a fair point. It's a critical trade-off. But I'd argue the best reports let the data itself provide the urgency. So my suggestion is to reframe it around the data.
Let the numbers do the talking.
Precisely. Focus on the strategic implications of the figures, especially that flip being EBITDA positive. The fact that you have a 4.5x price-to-sales ratio for a high-growth AI company that projected $200 million ARR, those numbers already scream undervalued. They don't need exclamation points to back them up.
So if we pull back on the adjectives and let that EBITDA flip take center stage, what does that actually mean for a small-cap company like RZLV? De-risking sounds great, but what does it do?
See, that's the deeper insight the analysis needs to hit on. Moving from negative to positive EBITDA isn't just an accounting trick. It fundamentally changes the company's access to capital.
Okay.
It opens the door to a whole new class of institutional investors. The ones whose mandates literally prevent them from touching unprofitable small caps. It signals maturity, operational efficiency, and a real path to self-sustainability.
So the transition itself is the real bombshell here, not just the language used to describe it.
100%. So to make this really actionable, you can go through and just replace those high-energy phrases. Instead of stop scrolling, talk about the strategic importance of this inflection point. Instead of just the shocking size of the $17 million, emphasize how the sustainability of that performance would validate their entire strategy.
Right, especially the India expansion, which we'll get to.
Exactly. Link the finance to the strategy, lose the hyperbole, and the whole thing gains this authoritative weight.
Okay, that makes perfect sense. Use the figures to build conviction, not just excitement. Let's pivot then to the core thesis. The upside potential is laid out very clearly. You've got the current price around $2.85 against an analyst target of almost $11.
Right. And the report gives a reason for the recent dip. It mentions tax loss harvesting, but then it also throws out low-volume manipulation.
That's a loaded term, and it's a really bold claim to make in a serious report. How do you back that up without just sounding, speculative?
You really can't, not without some serious data to back it up. And that's a perfect lead-in to our second major point. To bolster the integrity of the valuation thesis, the analysis must proactively acknowledge and mitigate potential limitations and risks.
So it has to play its own devil's advocate?
Exactly. Because the weakness right now is that it's completely one-sided. It's a pure bull case. And when a sophisticated reader sees that, their first thought isn't, wow, this is a sure thing. It's, okay, what am I not being told?
It makes a convicted thesis feel more like wishful thinking.
It really does. So the suggestion here is pretty simple. Introduce a brief high-level section. You could call it addressing skepticism or risk factors, whatever. The point is to proactively address the most obvious risks.
And then knock them down.
And then knock them down. You turn a potential weakness into a strength. It shows you've done the comprehensive due diligence.
I agree. That definitely builds trust. So, when you're talking about RZLV, there are a couple of obvious risks. There's just the inherent volatility of a small cap AI stock, and then there's the question of that $17 million figure itself. Is it a one-off? Which of those is the bigger threat to the thesis?
I think the seasonality risk is the most immediate threat.
Because the entire $200 million ARR projection hinges on it.
It all hinges on that one number from December 2025. And December can be a weird month, with year-end contract signings, so you have to address that uncertainty head-on.
Okay, so what are some concrete ways to do that?
Okay, 2 things. First, you have to explicitly talk about the potential seasonality of that guidance. Ask the question in the report, is this $17 million all recurring revenue, or is some of it non-repeatable? And then you offer a mitigation. For example, if you can confirm that it's driven by new multi-year contracts, then that shores up the whole run rate projection.
That makes sense.
Second, you just have to acknowledge the execution risk and volatility that comes with any small cap AI stock. You can't just ignore it. Address why the $11 target is justified despite these systemic risks. You frame the company's transition to profitability as the key hedge against that volatility. It prepares the reader for turbulence, but keeps their conviction in the long-term target.
Right. You're shifting from a defensive omission to an offensive mitigation. It shows you're in control of the facts.
And building on that control, let's talk about what the report correctly identifies as the company's biggest strategic advantage.
Okay, yeah, this was the part I found most compelling. The aggressive expansion into India, the partnerships with giants like Snapdeal and Reliance Retail's AGO, using their brain commerce tech. The analysis calls it a strategic masterstroke.
It's a fantastic narrative. It's the thing that really separates RZLV from the pack of US-focused competitors.
It feels like the secret sauce, right?
It does. But it's still mostly just a story. And that brings us to our third critique. The material needs to deepen the strategic context by providing concrete quantitative support for the India connection.
So, connect the narrative to the numbers.
Precisely. The story of conquering the fastest-growing digital economies is great, but the weakness is that the analysis fails to quantitatively link those partnerships, Snapdeal, AJO, to the financials. Like that December $17 million guidance. If this India play is what justifies a 300% upside, you have to show me how it translates into dollars and multiples.
Right now, it's asserted, not proven. It's a great storyline, but it feels more like a footnote than a core pillar of the $11 valuation.
You've got it. So the suggestion is to explicitly connect that geographic expansion to the metrics. You have to provide the context that proves why this move makes RZLV's 4.5x price-to-sales ratio look, as the report says, dirt cheap.
So how does the India market actually change the valuation model for a company like this compared to its peers in the US?
That is the absolute crux of the argument. When companies successfully penetrate a high-growth, underserved market like India, they often get a big valuation premium compared to peers in a saturated market like the US. It's all about the potential for exponential long-term growth.
Okay, so how do we make that actionable in the report?
2 key things. First, the report needs to provide some context on the revenue breakdown, even if it's a projection. What percentage of that $17 million is directly attributable to these new Indian partnerships? Quantifying that, even with an estimate, makes the case dramatically stronger.
It immediately makes the India move a real revenue engine, not just a headline.
Exactly. And second, you need to offer a comparison of PS ratios. Look at other AI or e-commerce companies that have successfully dominated the Indian market and compare their multiples to US-only companies. This demonstrates with hard numbers why the market should give RZLV a much higher multiple once these benefits are realized.
So you're basically arguing that RZLV needs to be benchmarked differently, not against its US peers, but as a high-growth, emerging market dominator.
That's the argument. And that's how you build a rock-solid case for that aggressive $11 target. It transforms the India partnership from a nice detail into a core financial driver of that 300% upside.